Your life at every level of the prop firm trading. There's a specific moment, and you'll remember it exactly when you first heard the words prop firm. You were probably watching something else. A trading video, a highlight reel, someone showing a brokerage statement with a number on it that didn't seem attached to anything real. And then the person in the video said, "I didn't use my own money." You leaned forward. You rewound it. "I didn't use my own money." Those 5 words will cost you more than you are currently able to calculate. Not because they're a lie, because they're almost true. And almost true is the most expensive kind of statement there is. This is your life at every level of the prop firm industry. Level 1, the discovery. You haven't paid anything yet. That's about to change. You find the prop firm space the way most people find it, through the back door of ambition. You've been trading for a little while, maybe a few months, maybe a year. Long enough to believe you have something. Short enough that the belief hasn't been seriously tested yet. You've seen some green days. You've had some losses that you've quietly reframed as lessons. Your personal account is small, smaller than you want it to be. And the math is always the problem. You know the math. You do it at night. If I had $10,000, I could make $500 in a week at 5%. If I had $50,000, that's $2,500 a week. If I had $100,000, you stop yourself there because $100,000 feels like a fantasy, and you've learned to be careful about which fantasies you let yourself finish. And then you discover that someone will give you $100,000 to trade. Not give, fund. There's a distinction, and you'll understand it later. Right now, all you hear is the number. You spend 3 days reading everything. Reddit threads at 1 a.m., YouTube deep dives you start at lunch and finish at dinner. Discord servers you join without saying anything, just lurking, scrolling, absorbing. You are building a map. Who are the legitimate firms? Who are the scams? What's the payout structure? What are the rules? You become briefly, intensely expert in a vocabulary you didn't know existed 2 weeks ago. Challenge phase, verification phase, funded account, maximum daily drawdown, consistency rule, profit split. You say these words to yourself while doing other things. Cooking, driving, in the shower. You are rehearsing a life you haven't entered yet. The challenge fee is $150 for the $10,000 account. You look at it for exactly a moment. $150. That's nothing. That's 2 dinners. That's a month of a streaming service you don't use anymore. You pay it before you finish that thought. You don't tell anyone. There's a version of this story. You're protecting the version where it works, and the moment you tell someone, they become a witness to the possibility that it doesn't. The challenge rules load on your screen. 4% maximum daily loss, 10% overall drawdown limit, 8% profit target, unlimited days to complete it. You read the rules 3 times, you screenshot them, you make a spreadsheet. You are going to be disciplined about this. You are going to treat it like a business. You've read that phrase somewhere, treat it like a business, and it has the comfortable weight of advice that sounds simple until the moment it asks something real of you. Day 1, you take a trade. It goes your way. Not a lot, but enough to feel like confirmation. You close it early because you don't trust it yet. You stare at the percentage number. You are 1.1% toward the profit target. You do the math on how many trades like that it would take to finish the challenge. The number feels manageable. The number feels like a plan. Day 3, you give back the 1.1% and then some. You're not in trouble yet. There's margin, but you feel it differently now. The drawdown limit isn't just a rule on a page anymore. It has gravity. You are aware of it the way you're aware of the edge of a high surface. Not scared exactly, just conscious of where it is at all times. Day 12, you've found a rhythm. Small wins. 1 frustrating flat day. You're at 4.3% profit. You are actually doing this. Day 17, you take a trade based on something you saw in a YouTube video that morning. It's not your setup. It doesn't fit your rules. You take it anyway because it feels right, and the profit target still has some distance in it, and you want to accelerate. The trade goes wrong immediately. You hold it because you've read that patience is a virtue. It gets worse. You close it. You've lost 4 days of progress in 22 minutes, and you sit there, very still, understanding something for the first time about the difference between a rule and a suggestion. Day 30. The challenge is over. You didn't hit the target. You are at negative 10% on the challenge. You were more than halfway there, and you lost it all. You sit with this for about 12 minutes, then you buy the reset. It's $89. The reset is always cheaper than the original challenge. The price of re-entry is calibrated to be just low enough that walking away feels irrational. You've already invested $150. What's another $89 to protect that? This is the first time the prop firm industry charges you for losing. It will not be the last. Level 2, the first funded account you passed. Nothing is different, and you thought something would be different. The email arrives on a Wednesday. Congratulations, you have successfully completed your challenge and verification phases. Your funded account is now active. You read it 4 times. You take a screenshot. You almost post it somewhere and then you don't because you're still not entirely sure what it means, and you've learned to wait until you know what something means before you let other people decide what it means for you. The funded account is $10,000. The rules are familiar. Max loss limits, daily drawdown, a profit split, 80% to you, 20% to the firm. You run the number immediately. If you make 10% this month, that's $800 to you. That's not quit your job money, but this is real money. It's proof of concept money. And right now, proof of concept is the only thing you're after. You take the first trade and your hands feel slightly wrong. Not shaky, just conscious. You are aware of your hands in a way you are not usually aware of your hands. There is a funded account active with your name attached to it and someone else's capital in it, and rules that are strict. And if you breach the drawdown limit, this account disappears and you'll have to pay to get back. This feeling, the funded weight, is not in any of the marketing materials. You close the month up 6.2%, you put in your first payout request on a Friday afternoon. 9 days later, $496 lands in your bank account. You stare at it. $496, 80% of your gain. The realest money you've ever made from trading. And also, when you do the full accounting, the first challenge fee, the reset fee, the month of data subscription, the Discord you pay for, the book you bought, you realize that $496 is not quite the number it looked like from the outside. But it happened. Real money moved into your real account from a trading account you built with skill. That's not nothing. That's actually not nothing at all. You immediately open a second challenge. Level 3, the multi-account phase. This is where it gets expensive in ways that don't show up on a single line. Someone in a server says something that rewires your thinking in a single sentence. They say, "Why are you running one account?" And you don't have a good answer. The logic is clean when it's laid out. You've proven you can pass a challenge. You have a funded account running profitably. The edge, if it's real, doesn't care how many accounts it operates across. If you can make 5% on $10,000, you can make 5% on $10,000 4 times simultaneously. That's not 4 times the work. It's the same trades, the same setups, the same execution, multiplied. The math on this is hard to argue with at 11 p.m. when you're doing it in a notebook. You buy 3 more challenges over the next 6 weeks. Different firms, different account sizes, spreading the risk because you've read about firm collapses and you don't want everything in one house. You have a spreadsheet now with 9 columns. Firm name, account size, challenge fee paid, current, P&L, drawdown remaining, payout schedule, rules summary. You are proud of the spreadsheet. The spreadsheet feels like a business. Passing 4 challenges simultaneously is a different skill than passing 1 carefully. You fail 1, you pass 2. You buy a reset on the failed one, you pass that. You now have 4 funded accounts across 3 firms. Total allocated capital, $85,000. Monthly payout potential on paper, if everything runs correctly, somewhere around $3,000 to $4,500. Nothing runs correctly. Something always goes wrong. The days when your read on the market is off don't cost you 1 account anymore. They cost you across the board simultaneously because you're taking the same setups, the same thesis, the same direction on all of them at once. A bad week isn't a $200 loss. It's a $200 loss 4 times, hitting 4 drawdown limits at the same time. And unlike a personal account where you can just sit still and wait for the environment to change, these accounts have clocks and limits, and they don't care that the market was unusually choppy this particular week. You lose 2 accounts in 1 bad stretch in February. Not dramatically. You didn't blow them up recklessly. The market just ground against your setups in small, consistent, maddening increments for 4 days, and the drawdown limits did what they were designed to do. You spend $280 to reset both. You update the spreadsheet. You don't mention it to anyone. You keep running the accounts that survived. This is the level where you start to understand the actual economics of the prop firm model, not the marketing economics. The real ones. The real ones are this. Firms profit most reliably when traders fail, not because they're rooting against you, because the business model is structured on the statistical reality that most people fail most challenges most of the time. The challenge fees are the product. The funded accounts are the marketing. The payout to the profitable traders, the real ones, the consistent ones, is a cost the firm manages, not a goal it chases. Some of these firms don't even put your trades into live markets. Your P and L is simulated. The money you receive when you win is real funded by the pool of fees from everyone who didn't win. This is not buried. It's in the documentation. You read it eventually, you sit with what it means for a while, you keep going anyway, because the money is still coming in. Slower than projected, more expensive than you planned, but coming in. Level 4, the professional attemptee, start treating it like a business. The business has margins you didn't project. Somewhere around month 14, you make a decision. You're going to do this seriously, not as a side thing, not as something you manage between other obligations. Seriously, with structure, with process, with the kind of intentionality you've been giving it in partial doses and that you now believe deserves the full one, you set up a dedicated workspace, a real desk, 2 monitors, a proper chair. You cancel 2 subscriptions and redirect that money to better tools, a professional charting platform, a better scanner, a newsfeed that doesn't have a 30-second delay. You build a trading plan document, not a list of setups, a document with a morning routine, a pre-market checklist, a post-session review template, a weekly review process. The document is 12 pages. You've read that elite traders have process, you are building process, you are running 5 funded accounts now. Total allocated capital across the firms, $175,000. You have passed 9 challenges in total, failed and reset 4 of them. You know your pass rate, it's not something you're proud of yet, but you track it because tracking it means you're serious. This is the month you first calculate your actual net P and L. You sit down with a spreadsheet, a different spreadsheet, a real one, not the tracking sheet, and you add up everything. Every challenge fee ever paid, every reset, every subscription, every tool, every book, every course, every coaching call. You subtract all of it from every payout you've ever received. The number is smaller than you expected, significantly smaller. You look at it for a long time. You are not in the red. But the margin between what you've earned and what you've spent to be able to earn it is thin in a way that is uncomfortable to look at directly. You've been thinking about gross payout. You've been telling yourself a gross payout story. The net story is quieter and it asks harder questions. You don't quit, you adjust. You get more selective about which firms you use. You stop buying challenges in sizes that don't match your actual strategy. You start being ruthless about which accounts you fund at all. You treat each challenge fee as a capital deployment decision, not a lottery ticket. This sounds obvious. It wasn't, not for a long time. At this level, you also start to encounter the rule problem for the first time at scale. Every firm has rules. You know this. But when you're running multiple accounts across multiple firms simultaneously, the rules aren't just guardrails anymore. They're a second market you're trading in. You have to manage your setups not just against market conditions, but against drawdown limits, daily loss caps, consistency requirements, time of day restrictions on some platforms, news blackout windows on others. You can catch a perfect setup and be unable to take it because it would push one account too close to a threshold. You can close a winner early, not because the trade told you to, but because the rule structure says you have to. You start to wonder quietly, privately, not something you'd say out loud in the Discord, whether the rules are making you a better trader or a more compliant one, whether those are the same thing. You don't have a clean answer. You keep going. Level 5, the scaling phase. The money is real now. The pressure is constant, and it doesn't feel like it used to. You hit $300,000 in total allocated capital across your funded accounts on a Thursday morning, and you notice it the way you notice the weather. It registers. It doesn't land. 12 months ago, this number would have felt like a destination. Now it feels like a position, a tool balance, something to work with. The money has changed, meaning somewhere in transit, and you can't identify exactly when that happened. You have 8 accounts. You've systematized the management to the point where your morning routine has a sequence, which accounts you check first, which you trade most aggressively based on where they sit relative to their drawdown limits, which you're trading conservatively because they're close to payout and you want to protect the gain. You are a portfolio manager now, except the portfolio is made up of risk parameters instead of assets. Your win rate across accounts has stabilized. It's not a number you're proud of posting publicly, but it's consistently positive, which you've come to understand is rarer than the marketing of this industry suggests. Most people who tell you their win rate are telling you their best month. You know your rolling 12-month number. It's less exciting than a highlight reel and more useful than almost anything else you've learned. At this level, you start to see the ceiling. Not the ceiling of what you can earn, the ceiling of what the model allows. There are position size limits in most funded accounts. There are scaling programs, the firms call them scaling programs, where consistent performance unlocks higher capital allocations. But the scaling is slow, it's deliberate. The firm controls it. And the dirty truth about scaling programs is that the firm's willingness to scale you is inversely related to how much of a payout liability you represent. The more consistently profitable you are, the more slowly they need to be about giving you more capital to be consistently profitable with. You start doing math you haven't done before. Real math. If you cap out the scaling programs at the firms you're currently with, what's the ceiling? You work through it. The number is real. It's not nothing. But it's also not the number that was implied by the marketing you found at the beginning of this. The lifestyle shots. The income screenshots. The people who casually mention 7 figures the way other people mention next year. You have a conversation with someone who's been in the industry longer than you. Not a coach, not a content creator, someone who's actually been inside these firms, who knows how the reconciliation works, who understands the actual mechanics of how payouts get processed. The conversation is short and it's precise, and it leaves you with 3 things to look into that you hadn't thought to look into before. You spend a week looking into them. What you find isn't fraud. It's not a scam in the simple sense. It's structure. It's the way the incentives are arranged inside the model, which is not the same as the way they were presented to you at the beginning. And the gap between the presentation and the structure is not a lie. It's a business. And you're starting to understand the business from the inside for the first time. Level 6, the funded trader with real capital. You make a decision that the industry didn't expect. You start using your own money. The decision doesn't come from frustration. You want to be clear about that. It comes from math. You've been running prop firm accounts for almost 2.5 years. You've tracked everything. You know your edge, you know your win rate, you know your average risk reward. You know what your strategy does across different market conditions because you have the trade log to prove it. Hundreds of documented trades with notes, with grades, with the honest accounting of what you did right and what you compromised on and why. You have capital now. Real capital. Earned from payouts, from the job you still technically have but barely attend mentally, from a year of extremely low personal expenditure during a stretch where you just didn't spend anything that wasn't absolutely necessary. And you sit down one evening and you ask yourself the cleanest version of a question you've been avoiding. If my edge is real, why am I renting someone else's capital to express it? You open a brokerage account with your own money. Not a lot. $18,000. Every dollar of it earned, tracked, real. The first trade you place in a personal account after 2.5 years of prop firm accounts feels physically different. The risk is yours. The upside is yours. There's no rule book running underneath the decision. There's no drawdown limit that will pull the rug out. There's no firm receiving 20% of your profit for providing the infrastructure. There is also no one to blame but yourself. That last part is not a small thing. You've been operating inside a structure that externalized some of the consequence if an account got breached. You reset it, you moved on. The loss was real, but contained. Here, there is no reset button. There's just your account and what you do to it, and what it reflects back about your actual skill versus your skill at navigating prop firm rules. The first month is your best trading month in 2 years. You don't know what to do with that information. You sit with it. You don't close all your prop firm accounts. That would be dramatic. And drama is something you stopped having patience for around month 18. You scale back. You keep 2 accounts with one firm, the firm with the cleanest payout history, the one that's never missed a withdrawal, and you run them on the side while your personal account becomes the primary vehicle. The math, when you do it properly, is different than you expected. The prop firm was providing leverage you didn't technically need in exchange for rules that were costing you setups you would have taken otherwise, in exchange for a profit split that was reasonable in isolation but expensive when you factored in the behavioral drag of trading to the rules instead of trading to the market. This is not a criticism of the model. The model is what it is. It serves a purpose. It served your purpose for 2.5 years. It taught you something you couldn't have learned any other way, which is what your edge looks like under pressure, across time, with real stakes, documented. But you're past the point where you need someone else's capital to find out if you can trade. You already know if you can trade. Somewhere on a screen right now, someone is reading about prop firms for the first time. They're doing the math. They're excited about the math. The math is very clean right now because it hasn't met reality yet. They're about to pay $150, and that's going to feel like an investment, and it is just not the kind they think. They're going to learn something. Eventually, the question is just what it costs them before they do. You know this not because you're smarter than they are, because you were them. The screen is open. Somewhere, a challenge timer just started. Someone thinks this is simple, they'll find out it isn't. And what they build from the wreckage of that finding out, if they stay honest, if they track the real number, if they don't protect the story at the expense of the accounting, just might be worth every dollar of the education.